I'm back with another case study to help you determine if you should be adding new money to a Roth 401k or a traditional 401k. This is a very common question, and you're wondering what's going to put me in the best tax situation, not just this year, but for years moving forward. I'm going to walk you through a real example right now. So you can see on my screen this software I'm going through to help determine if you can do pre-tax or Roth and what's going to optimize it. This is available to you. So if you go in the description, you can see this early retirement academy I have where you can play around with exactly what I'm showing you today. Now, I want to always walk you through who's the couple we're working with so you can understand this and how it might apply to your situation. So you can see here, these are real people. I just changed their names. They don't have any children. They're 52 and 53. Now, their goals roughly is to retire at 55. They're not married to it, but that's what they're thinking. So that's, once again, a few years out. They're saying, hey, maybe we spend $8,000 a month in retirement. There's some healthcare costs. Do we do a home remodel? I would encourage this couple to build it out deeper and go, well, maybe it's not a child they want to help out, but a niece or nephew for college. How often are they buying cars? Is it every 10 years, every 5 years? Vacations, how often are they taking them? And they can get really detailed with this. You can do the same thing I'm showing you right now when you're in the academy, but let's just assume when they retire, they're going to want to spend every year for, let's just say 15 years, $25,000 a year. I want this level of detail in the plan, whether it's they're going to move or help out with weddings or give money, because this is how we really can build out a strategic strategy. Now, this couple, you can see their income is $115,000 and $85,000. That's what's coming in the door. Social Security, not a consideration yet, not coming in. Now, what I like to do in these cases, before throwing into the software, and this is a pro tip if you're in the academy right now, is I like to put your 401k, just for example's sake, just for a second, on 0. So I have the spouse's 401k because they are getting 3%. They're putting in 3% and they're getting 3%. I'm going to put it on 0. Now, I'm not recommending they do 0. I'm just going to show you when you think about Roth 401k and traditional 401k, how to actually implement it in your plan to determine what's going to put the most money in your pocket. So before I get back to this, a quick pause and a refresher on what are these different options. Traditional 401k gives you a deduction today. Let's just assume, very simple, you make $100,000. That's your income. So $100,000 is your income. Now you give $20,000 to a 401k. Now you can do more than that. I'm going to show you all that in a second, but let's just assume you give $20,000. The government says, great job saving for retirement. You owe us taxes on your income. And you're like, well, I did this 401k. So because of that, my income is not $100,000. It's 100 minus 20. That's $80,000 of income. Now there's deductions and things beyond that, just keeping it simple. Now Roth 401k, you're like, whoa, what is that? Well, a common myth is most people don't know you can do Roth 401k and Roth IRA. It's not one or the other. You can do both. What you cannot do is do Roth 401k, max it out, and traditional 401k, maxed out. That's illegal. But if you wanted, you could do max 401k and Roth IRA. With IRAs, there's some little tricky things I'm going to show you. But the important thing to know is if you're wondering Roth 401k or traditional 401k, Roth 401k won't save you any taxes today. You still are going to have to pay taxes, but you're doing it to never pay taxes ever again. So the common question, whether you're in your 20s and 30s or 50s and 60s, is, hey, should I be doing traditional right now, where if I'm bringing in, $250,000, this couple's bringing in $200,000. So they're going, look, we're in the 22% bracket. What should we do? Should we do the traditional 401k, get a deduction at that 22% rate? Should we do Roth instead? Who knows? Well, what you should do is ask yourself, what is your current pre-tax balance? Meaning, if you already have a ton of money in your 401k, and let's assume you're 50, just to keep it simple here, and you have $1 million in there, well, that money is going to double conservatively in 10 years, probably more than that. But let's just assume in 10 years. So now your 1 million is worth 2 million when you're 60. Then it's worth 4 million when you're 70. Well, if you never touch that at all, $4 million, that's a lot of money in your pre-tax accounts. You're going to have in the future what are called required distributions. I'm going to do a calculation with you right now. So let's assume you've got $4 million at age 70. Your RMDs don't begin until 75 for most of you. So as you can see here, $152,000. That is a very rough estimate. On a $4 million, what would your RMD begin at? So $152,000 is what would be called your required minimum distribution at age 75. And you probably have Social Security, and maybe there's pension. What if you inherited an account from your mom or dad? What if there's rental income? So you might have $300,000-$400,000 coming in the door when you're in your 70s. You're like, look, I don't need that. And I'm like, guys, I know government doesn't care, and they're going to force you to take out that money. And that all gets taxed at your highest bracket. So for a lot of you right now, you're wondering, hey, should I not add more money to my traditional 401k? Yeah, I know I could get a deduction today, and that would help my taxes today. But in the future, isn't it just like adding to this future tax bomb? And the answer is yes for a lot of you. For others of you, if you're like, look, let's look at this person. Just take an example. This person here has $815,000. All of their money is pre-tax. They don't have a brokerage account. They don't have an inherited account. Excuse me. They have a 401k and 2 IRAs. All of that is pre-tax money. So in their case, we're going to come back to this in just a second. In their case, they're wondering, well, what should we do? Should we do pre-tax? Should we do Roth? And I say, hey, let me just show you. But the safe answer is always, if your cash flow allows for it, do Roth. Roth, I want you to think about like insurance protection. So when you go buy insurance and you buy, fire insurance, you're not hoping a fire happens. You're like, look, I'm paying for something, hoping I never get my money back. I just want to pay for this. And if something happens, I know I'm okay, but I hope I don't get my money back because then your house didn't burn down. With Roth, it's similar, where I want you to go, look, I'm going to pay taxes today. I know tax brackets might go up. I know I might be in a different tax bracket later, but I don't know. So I'm going to take advantage of the current bracket I'm in just to lock it in. So that's what you're doing with a Roth benefit. The other benefit, which is the big one, is as that money grows and grows and grows and grows and grows, tax-free, you don't have to pay any taxes ever again on that money. So we're going to talk about Roth, pre-tax, all of those intricate details right now. But once again, if you're wondering, hey, what am I playing around with right now? How do I get access to this? This is the Early Retirement Academy so that you can go and play around with your own projections on your own. So what you can see in here is there's a lot. There's a lot of how long until, how long should I work? How much do I spend? What about healthcare? What about vacation? There's a lot of stuff in here. Now, right off the bat, their plan looks terrible. And some of you guys are like, oh my God, this is the scariest thing I've ever seen. That I don't want that to be us. We have $825,000. And this was a couple that was just saying, hey, what if we retired at 55 and spent $8,000 a month in retirement? And once again, I turned on that vacation for them. So I was saying, hey, I'm going to make them spend $25,000 a year. Real quick, let's assume they go, you know what, Ari, turns out $6,000 a month is plenty. We don't need $25,000 on travel. $10,000 is good. If you refresh that, just watch what happens to the plan. Well, it makes a difference, but it's not like night and day. Like they're still running out of money. So you're like, hey, this doesn't look too good. Well, what if they worked until 60? Now, I'm not saying to do that, but the point here of why you use this software is to ask yourself, okay, do I want to work till 60 and have $7 million? You probably don't. So where's the balance here? What if they both stopped at 58? You guys get my point here, okay? The reason I do planning is so that people are retiring on their own terms and they're not overlooking anything. What about healthcare? Everything we talk about here. So now let's assume that they say, you know what, 57 and 56 for us, retire on our own terms. What are we thinking about? It gets us pretty close. We're at 88, Now this is all assuming, once again, they retire at 56, 57, they spend $6,000 a month, $10,000 on vacation, home improvements. There's a lot to this, okay? Now, what's a big consideration? Well, a big consideration is, should they do Roth 401k or traditional 401k? Now, let's assume they do traditional 401k. Just for a second, humor me, okay? Now, they're going to do traditional 401k. So they're going to add more money. That's good. They add more money. So if they add more money, what's going to happen is they're going to have $309,000 if they were to pass away at age 90 based on everything I'm exactly showing here. Now, that's significant. Remember, without that 401k contribution, they were at nothing. But let's assume I turn that off and I say do Roth 401k instead. Same thing, just switching it to Roth. no pre-tax, no difference. You can see here, well, now it says 368,000. So the difference as to why they have more is the money's growing tax-free. So you're like, okay, I kind of see what you're saying there. There's a little difference, but I just I'm not really sold on it. I go, okay, let me show you a better example. Let's assume they both work until 58. And they're like, look, we're good with spending $6,000 a month, $10,000 on vacation. We're good with that. No Roth 401k. The importance of doing Roth or pre-tax grows as your investments grow. So here they are on track for $4.3 million. Now let's assume they said, hey, that sounds good to me. Like I want to die with $4 million. Most of you don't. Okay. Most of you are like, look, that's too much money. I don't want to die with $4 million. But let's assume you did. And they said, we want to add money to our pre-tax 401k. And if they do that, watch what's going to happen. Well, now all of a sudden, they're on track for $4.9 million. That's a lot of money. $4.9 million. Keep that in mind. $4.9 million versus doing Roth 401k. All of a sudden, you go here and you're like, okay, $4.98 million. Okay, so it's like not a big difference. Why would I pay more taxes? Like, what's the deal here? Well, the deal here, and where's all the details, it's all actually happening in this one page that you can't see because I haven't shown it to you yet. You can see it in the Academy, which is called the cash flow page. So what you're seeing here, I want them to scroll down until you see where it says plan distributions. These are what's called required distributions. So in the future, they're going to have Social Security and they're going to have $137,000 that they're going to have to take out. So that's a total of $230,000 coming in the door. Their expenses are $180,000 and their taxes are about $30,000. So that means $231 coming in the door, $211 expenses. That's $20,000 left over that gets taxed at their highest bracket. Doesn't seem like a big deal today, but as their money grows, it is a really big deal. So if we go back to the analysis here, on paper, they'll go, oh, what's the big deal here? You do Roth, you do pre-tax, yeah, I get it, $80,000, $90,000 difference. In their case, because of how early they're retiring, they get to be strategic. So based on their example here, if we were to say, hey, which one's going to put more money into their pocket, let's assume we do pre-tax just for a second. They get a deduction today, great, while they're making money. Here they are. So technically you'd get a little bit more benefit from doing Roth, but now watch what happens. If we go to the tax tab here and we're looking at their overall tax strategy, all of a sudden, what they are going to start thinking about is going, well, should we do Roth conversions? And is that going to make sense for our plan? And is that going to add value? And sometimes the answer is no. It's actually better to do nothing at all. Other times, the answer, and this could be dependent on a lot of different factors here, is a resounding yes, where you could do Roth conversions and it can add $200,000 to your plan. So what you want to ask yourself right now, if you're going, hey, should I do Roth? Should I do pre-tax? Where should I be saving more money? How much should I be saving? All of these types of details, well, it's going to vastly change. And I'm going to give you an example why. Because if I reset this to the base case, what I'm going to do, just so you guys can get a clear example here, I'm going to change their ages here. So now, they really do live in Connecticut. There's real couples, but I'm just going to change their ages just for a second. Just humor me. I'm going to put them, let's assume they're both 48 right now. Now, let's assume when they're 48, they have a longer time horizon, once again. So their money can grow and grow and grow and grow and grow. So in this case, what we did is we added on that vacation for them. What if they're like, Ari, you got it wrong. Like $8,000 a month, that's good. That already included our vacation. So like we don't need that extra. Well, now all of a sudden, they're retiring at 55. They're on track for $300,000 at the end. You add in some 401k contributions at 3%. It's looking pretty good. Like their plan, all of a sudden, it's like, hey, they're on track to $1.39 million. But now let's switch that for Roth 401k. And let's assume they're doing 3%. You could assume they're doing 5%. You can have your pick. Well, what you just see here, instead of 1.3 million, it's now showing 1.5 million. So you're like, whoa, whoa, whoa. Like, what the heck just happened? They have $250,000 more dollars, about $220,000, and they just switched it from Roth to traditional. Well, what happened, guys, is that Roth money has more time to compound and grow tax-free. So the value of the money, the opportunity cost is a lot greater because of how long they have in their time horizon. So when you're earlier on in your career, that Roth 401k, even if you're in a high tax bracket, might make a lot of sense. Now, if you go, look, I'm in a super high tax bracket, but I don't know what I should do, the safe thing to do is you can, of course, do the pre-tax if you're not sure. And then if you retire at 55, like this couple, you got a deduction at 22%. That's their tax bracket. Then they retire. Guess what happens when they retire? Their tax bracket goes down. Now they can convert money. Maybe they can get the deduction at 22%, then retire. Their tax bracket, maybe they're in the 12% bracket, and you do conversions at 12%. So deductions at 22, save taxes at 22, convert at 12. So you're not going to go wrong if you do pre-tax. You just might have to do more Roth conversions later. And in the meantime, your money's not growing tax-free. It's growing tax-deferred in a 401k. So lots of details today. You can see lots of nuance. I would encourage, as you can tell, go play around with this on your own. Run your own projection. See what it looks like for you. Play around with Roth, pre-tax, different variations. You might find there's something that works best for your plan. So hopefully this is helpful. Roth versus pre-tax, how to think through this. If it is, please do comment. Please do subscribe for more information just like this. And I'll see you guys next time.